Welcome to another episode of Purchase to Profits. I'm Seth Ferguson. Make sure you hit the subscribe button so you don't miss our daily interviews with successful real estate investors. Our guest today has been involved in 50 separate real estate properties and is the operations manager in 12 joint ventures. And when he's not doing real estate, he's a full-time police constable. Jules McKenzie joins us today. Jules, welcome to Purchase to Profits. It's great to have you on the show.
Hey, Seth, thanks for having me. I appreciate it very much.
Yeah, I'm really looking forward to this. A fellow Canadian, I would say 3/4 of our guests are American, so it's nice to have another
really?
on the show. Yeah,
that's interesting. Interesting you say that. My first podcast interview was a couple of years ago with a guy named Joe Fairless.
Joe,
and,
yeah.
I was so surprised when they sent me an invite on LinkedIn. And they said that they were aware of my successes and the things that I like to work on, and they'd really like to interview me. And I was so surprised. I said, I'm from Central Eastern Canada, right? I'm not an American. And they were more than happy to have us sharing their experience. So thanks again, Seth. How can I help you today?
Yeah, so let's talk about your real estate goals first. What do you want to accomplish with real estate?
So primarily, I'm working towards financial independence through owning some small multifamily real estate properties. My beautiful wife and I manage all of our own holdings together. To update you on, I think that profile you got from one of the real estate books that I wrote a passage for. Am I correct?
Yeah, it would have either been from a website or from one of your publications, something around there. I'm not sure where we got it from.
Well, thanks to my real estate mentor, Don Campbell. He wrote a book a few years ago called 51 Success Stories. And that introduction you gave me sure sounds like it came from a passage in that book.
Yeah, well, it's probably on my bookshelf.
Yeah, actually, I see it right over there.
Yeah.
Currently, Ange and I are holding 20 properties.
Oh, nice.
Yeah, we only have two key joint investors to date. One of those, she's an artist, and she's more within recent history. And when I say recent history, I would say around 2009, 2011, we started investing with this person from the city. And then one of my other key investors was an individual I met through RAIN, the Real Estate Investment Network, at a meeting. He was a student at UFT at the time, and then he took his first corporate job in Singapore. So he was my investor from abroad. And those are the only two investors I have now. We're holding 20 properties currently. As far as my long-term goals, we do want to continue to sell off some of the portfolio, maybe eventually pay out our investors, and just like they say, right off into the sunset. Financially independent.
Yeah, and what does that financial independence look like for you? Because that number can vary from person to person.
Currently, I want to replace my job income. So. If you want to talk about some hard numbers, let's talk about some hard numbers.
Okay.
I make roughly about $120,000 a year being a police officer at the rank that I am. So in order to replace that, I have to have at least $10,000 a month in passive income coming from the rentals. So that could very well be paying out the debt on the 20 plus properties that we have now, or maybe just holding on to 10. Mm-hmm. I have about 5 years to go in real estate. Sorry, I have many more years to go in real estate. I have about 5 years to go left in policing. So I'm starting the process now to start planning on which mortgages we'll pay down, pay off, which properties we will sell, and those kind of things. When I do retire, my goal, I would like to get my commercial real estate broker's license and start into the realm of commercial real estate, not just in the realm of commercial multifamily, but also look at industrial, look at office, and other aspects of commercial real estate, educate myself so that I feel like with the 15 plus years experience that I have, investing and living in this area, and included in that is Barrie, that I would bring a lot to the table and be able to service my clients to the utmost service that they require.
Yeah, no, that's great. So would it be safe to say that, so are you looking at acquiring some more properties right now, or are you just kind of in that holding pattern and figuring out how to pay off that debt?
Funny you mentioned that. Every single transaction that I've done within the last 5 years, I've told Angie, I said, okay, this is the last one. I'm not going to acquire any more. And next thing, lo and behold, I'll talk to you about two recent transactions. One is a beautifully fully renovated fourplex I'm purchasing off of the Marinakos family here in Aurelia. They given me the gracious opportunity to rent out the apartments as they were completed. And another transaction I just purchased with my young son, my 22-year-old son and his girlfriend, as their first personal residence and investment property. And right when I'm done this interview, I'm going to go help them slug some furniture and move into that place. So I'm really proud of that most recent transaction with my son and his girlfriend.
Yeah, no, and that's a good start for them as well, because as we're in that financing crunch right now. It's very tough to get finance. They want 2 legs, 2 arms, and your firstborn child. So,
well, they got my firstborn child. The B20 rules that are implemented by OSFI have just been terrible. It's just been horrendous. I don't know where young people go to get mortgage financing nowadays. Like, there's so many hurdles that they have to go through. And I just can't believe that our economy and our government sees the necessity to continue to put these hurdles and make these roadblocks for young people who want to strive for home ownership.
Yeah. And just for our American viewers, what we're talking about is the government recently imposed a stress test where you basically have to qualify at a couple percentage points higher than what your mortgage will actually be. The idea being that you're going to be able to withstand any rate fluctuations in the future. That's kind of like a Coles Notes version, just in case somebody doesn't really know. So in terms of as you started building your portfolio, what changes did you have to make in the way you thought about real estate to go from your first property all to scale up to where you're at right now?
I think I had to teach myself to get out of the way and let the professionals do their job, and not be afraid to hire those professionals to represent me and my interests and the interests of my joint venture partners. There's no possible way that I could, like back in 2005, up until about 2011 when we had the big joint venture, there's no possible way I could, adequately service and manage 50 plus properties and, maybe 100 plus tenants. There's just no way. So scaling that meant for me that I had to bring on a manager. I had to bring on some handy people that I could have ready to go and service those properties if and when needed. And then we had to automate. We had to, I realize that a lot of the listeners now are probably fully automated with internet technology and whatnot. But, back in the day, using QuickBooks and an online format to do a record keeping bookkeeping, that was completely foreign. And I'm speaking about a period between 2003 and 2008, and we had to streamline a lot of our record and accounting. So, it's systems, having those systems in place for management, systems for renovation, systems for record keeping and accounting and tenant selection, having all that stuff in place and having a good team around you to help you to get that done. I think that's key.
For sure. And, how do you approach, because right now, especially in the Greater Toronto area, and for those listening from the States, Toronto's a primary market. Barrie is about an hour north of Toronto, and that would be like a tertiary market, and Aurelia is about half an hour away from that. Do you invest primarily in that Aurelia market? Yeah. Okay.
Now I do. Like when we started selling off the portfolio in its larger sense, we started reinvesting into our own properties and our own projects. and paying out subsequent investors so that we could have our own holdings, start building our own nest egg. But I like the fact that with real estate, I can have 100% control. So, if I'm kind of feverish about what's going on in the stock market or what's going on in the economy or what's going on with our mortgage stress test rules, I can simply wake up or get out of bed, take a drive down onto one of the streets that I own and touch the building and say, oh yeah, it's still there.
Yeah.
I like having that ability. And I just like having my holdings all in one place. And it really is a great town. I mean, we're between two lakes. We're between two major highways. The OPP have their general headquarters here. Casino Rama's right across the lake. It's just an awesome area.
Yeah. And how are you approaching, because right now, especially in the Greater Toronto area, it's very tough to find cash flowing properties, especially if you're following the guideline, that you mentioned RAIN, the Real Estate Investment Network. If you're following kind of that philosophy of investing cash flow positive properties, they're tough to find. So what strategies are you employing to make sure you're buying into a cash flow positive property?
So years ago, I learned the 10% solution. So for example, if I'm looking at a piece of property, say it's a single family condominium, and the rent that I could get for that is $1,000, 10 by that rent and divided by 10. So the monthly rent times 12 divided by the purchase price gives you roughly a 10%.
Mm-hmm.
If that calculation works out, then I pursue that further to make sure that the property is in a good state of repair. It's manageable. The tenant's good. It's in a good neighborhood. I make sure to do all those kind of things. But that 10% solution, that's been a guideline for me for many, many years.
Yeah, and I'm sure if we have listeners from major cities, that they'll be like, that doesn't exist because people are buying properties at a 3 cap. So you've really become an expert in your local market. You know it inside and out. And are you finding those properties where you'll get like a 10 cap?
Yeah. I'd, not necessarily a 10 cap.
Yeah. I'm throwing that term around very loosely for what we're talking about. So
yeah. So I would say that to be fair to the listeners, most of my properties that I'm holding on to are roughly around a 5.
Okay.
We're using the commercial capitalization rate, but yeah, I still apply those fundamentals. For example, the fourplex that we're closing on, the investment fourplex, it's actually not a 10% solution. It's more of an 8%. But it was explained to me many, many years ago that, like Toronto is really the heart of our real estate area. I mean, hundreds of thousands of people immigrating to this country are landing in Toronto. So that puts a draw on the residences down there, and purchasing those residences keeps going up in value. And it's kind of like dropping a big rock in the center of a pond that starts rippling out. Strategically or geographically, I had the good fortune of being in this area, just on the outside of that Greater Toronto area, where the rents, prices are much lower up here in Aurelia, but the rents are not all that different. There are some low to moderate income areas where the rents are pretty low, but there are some good areas too that, the rents are pretty comparable to city type rents.
Yeah.
I don't know if that answers your question.
Oh, no, that you did a good job. So basically you're getting similar rents, but your purchase price is probably what, like a third?
Yeah, pretty close. Yeah, maybe three quarters of what people are purchasing down in the city. Certainly we don't have 1,800 square foot, $1 million bungalows up here. At least I don't think so. I haven't really looked at the single family market in a while.
Yeah. And so for yourself, as your business has grown, do you have any routines you follow maybe daily or weekly that helps keep you focused?
Spiritually, yes. I take a moment out and get myself centered. I pray. I ask that my successes in endeavors in my investing in my personal life, in my fitness, in my family, inspire and help people to want to achieve the same kind of success. And then, I got to get my coffee in, man. I'm getting to that age where I need to have about 2 or 3 cups to get going. Once I get going, I work on, some headspace. What I mean by that is reading a good book for 15, 20 minutes, making sure I get my frame of mind in the right place. Because you know what it's like being a landlord. There could be challenges day in and day out, and you got to keep your goals and keep your headspace straight. Physically, I go to CrossFit Exhilarate, and I've been doing that for the last 3 years, and I'm doing things that I never thought would be possible, climbing ropes and doing toes to bar and throwing bars over my head that are 225 pounds plus, and just doing all kinds of incredible things. So I think that in order for anyone, really, not just us investors, but anyone, you really have to take your life seriously, not take yourself so seriously, but the aspects of your mental, your spiritual, your physical. You gotta make sure that you're improving on those attributes of yourself so that you have a lot to give.
For sure. And is that a walking desk right behind you? Or standing a walking
no, it's not a walking desk. It's actually a treadmill. We just bought this thing, and we didn't have anywhere else to put it that would work. So my wife likes to watch Netflix actually on my computer. So we just put it here behind me. So it's kind of like, oh man, I hope he doesn't notice the treadmill.
Oh, so sorry, I totally blew that cover.
Yeah.
Oh, that's great. So out of all the deals that you've done so far, is there one that stands out as a Keystone deal?
It still stands out in my mind. I told my realtor back in 2004 that I was looking for, anything that would, give an opportunity for investor to, for this investor to bring in subsequent investors, rent them out, have good property management. And at that time, he called me up and he says, I have a deal for 38 townhouses by one owner who's an out-of-town owner, and he wants to sell them. And at that time, he was selling them for $107,000 a door. And he says, this is your shot, take it or leave it. So I went, and I wasn't in a particularly good headspace. I had made some horrible mistakes with my personal finances and my investing career to date. And I had him draft the offer. I had to go see my real estate appraiser, who's also a private lender, and he loaned me the $5,000 to put down on the offer contract. And I even think he drafted a promissory note for 12% interest for the few months that I was going to have that $5,000 on the offer contract. So I went out and I hit my RAIN real estate investment network pretty hard and raised the capital. I raised a little over $1 million to purchase those properties. I maintained the management company that was involved, and we kept those properties for a really long time. In 2015, we kind of severed the joint venture partnership there. One of the investors took out 11 mortgages, and I took out 11 mortgages, and we paid out our subsequent investors. So out of those 38 townhouses, Angie and I currently own 11.
Nice.
The valuation on those homes now are in the range of $229,000. And I'm sure somebody in the Ontario market is listening right now saying, no, they're more like 300,000. So I'm just giving that some time to sit in my mind that they're coming in at a valuation that's significantly higher than when I purchased them in 2005.
Yeah. And was that your first time raising money? You mentioned you had to raise about $1 million.
No, my first time raising money was for a small townhouse deal. And at the time it was, I think it was $90,000 to purchase a townhouse in another part of town. And the investor at the time wanted me to give him the interest payment on his line of credit that he was taking from, because the money was coming from his home equity line credit. That was really my first joint venture. So thankfully, we're in an area that has cash flow, so I was able to pay his interest on his line of credit payment.
Yeah, and you know, for this townhouse deal that you purchased, you know, you raised $1 million. Most people, when they're first starting out, that number seems intimidating. Was it a lot harder than you thought it would be? How did that process go?
Ironically, I would say that drumming up the courage and putting my facts down on paper and getting them straight in my head before I start talking about them was a lot harder for the one townhouse that I mentioned, where the only pushback from the investor was that he wanted me to make his interest payment on his line of credit. That was a harder sell than selling 38 townhouses to some fairly astute businessmen who were looking for a place to put their capital that would be safe. That was a much easier sell, in my opinion, when I look back on it now.
Yeah, and then that's a very common theme I hear from a lot of successful investors. You know, they'll say even if they're raising $5 million, that's easier to do than a small deal.
Yes.
Yeah. And so your game plan with that one, so you mortgaged 11 properties, the other investor mortgaged 11 properties just to buy out the rest?
Yeah, that's right. So we did that. He paid me a small sum of monies to leave his 11 units. He wasn't part of the 11 units that I took over. So he got what he wanted. He's a longtime investor as well. We still both own our 22 units in this particular townhouse complex. We're still on the condominium board, and we still work together quite well, and we still remain very good friends to this day. So I think it's worked out well.
Yeah, and would you say most of your other properties, are they triplexes, fourplexes, or do you have a mix of single families in there?
We did purchase a single family in 2017, actually down the street from where we live. We seen this new townhouse come on the market, come off the market, come on the market, and my wife said, "You got to go talk to this gal about purchasing her house." And it was a single family home in the Westridge area, which is the west end of Aurelia, where there's a lot of development going on. And she was having a difficult time. She had just purchased the property. Her job was initially transferred up from the city of Toronto, and then she got a promotion back at the same hospital in the city, so she had to sell quickly. So we ended up making a deal for $335,000, which I thought, oh my gosh, like, how am I going to do this? I have to rent out this home for $2,000 a month. The only real condition I put on that offer was my ability to show the property and capture $2,000 a month. And lo and behold, within a week, I had some great OPP tenants that were in between homes that were going to be renting for a year while their new spacious home was being built. And that sold me on purchasing that single family home that we did purchase. But our portfolio nowadays is primarily comprised of small multifamily. And the reason I do that is because we started with a small fourplex and a duplex. And I understand them. I understand the tenant profile. I understand the mechanics of how those smaller buildings work. And I just like the ability to have the control. I cut the grass in front of some of those buildings. I let the neighbors know that I'm around paying attention. And small multifamily is it had been up until recently, it had been pretty easy to finance and get good financing on. But yeah, I would say the majority of our portfolio nowadays is fourplex, triplex, fiveplex type stuff.
Yeah. And let's say somebody's starting out today from scratch with the current lending environment. What advice would you give them to start building a portfolio today?
Wow. You don't ask much, do you? So I would say that, it really depends where they're starting from. And what their educational background, what their business background is, because some people can start, right into commercial multifamily, maybe 15, 20 unit apartment building. They can start there, and good for them. That's where they should start. For other people, maybe it is purchasing a home to move into, finish the basement with a secondary suite, dependent on their city's zoning bylaws, and then move out and purchase another home and do it all over again. Maybe that's where they start.
Yeah.
It really depends where they're starting from.
Yeah, no, that's a good way to put it, because, like you said, everybody's situation is different, and it all depends on what you're working towards as well. Everybody has a different goal.
Yeah.
Yeah.
So, and I want to cite my son's example. Like he's chosen, not chosen to go into the law enforcement tradition of our family, which is fine. I mean, it's not for everybody. He's chosen a little harder route in being an artist. So he's in a band.
That's a lot harder.
That's a lot harder. He's in a band. He plays music. He plays guitar, and they tour all over to Collingwood, Ontario, Midland, down to Barrie. I think they've played Lee's Palace in the city of Toronto, and he also picks up modeling gigs on the side. So he works.
Well, he looks like his dad. That's why he got the good gene.
You're very kind. Very kind. Yes, of course. He works part-time, as a lot of young people in this marketplace do. They have part-time jobs that are not necessarily, the most favorable or stable in the bank's mind or eyes.
Mm-hmm.
So, maybe purchasing that first property where there is a secondary suite already in existence, where they can offset some of their living costs. Maybe that's the way to go for young people, so that they can start building their own equity and eventually start building upon their financial plan to gain their independence through real estate investing.
Yeah, no, I'm glad you brought up your son's example, because I think that's a situation a lot of people find themselves in right now.
Yeah.
So looking back at, how has getting into real estate changed your life?
Oh, it's changed every aspect of it. I mean, I look at my coworkers, and great guys to work with, but a lot of them take vacations and buy boats and snowmobiles and four-wheelers on credit, and we look at that as bad debt. I can rent snowmobiles, and they say, why the heck would you rent somebody else's snowmobile? Well, because I don't have to pay cash, have all that money tied up in new units and maintain them and store them. And then they talk about all my debt tied up in mortgages. Well, you know what? Mortgage debt is good debt, because it's debt that's helping me to pay for an asset that pays me on a monthly basis.
Yeah, it's just a totally different mindset and a view of money. And that's one of the reasons I do this show, just to get the word out there and educate people, because there's so many people out there who don't understand how real estate can really shift your life around. Yeah,
that's exactly it. And it's not the only way. I mean, it's just a way. It's a way for most common people, and I consider myself to be a common person, to have a shot at gaining our financial independence, so we don't have to continue working so hard, and we can enjoy the things in life.
Yeah, that's what it's all about. So, Jules, if somebody's looking to get in touch with you or learn more about what you're doing, where can they find you?
So there's a few places. I really like Twitter. So on Twitter, my handle is at Mr. Jules McKenzie, and I'll spell that as MrJulesMcKenzie. I'm also on the Instagram, but I'm mostly showing off my CrossFit workouts on my Instagram. That one's Mackenzie.Jules. Very simply, my last name and my first name divided by a period. And then on the Facebook, it's very simply Jules McKenzie. I do have a website. I've been meaning to update it. I haven't got around to it yet, but it's McKenzie Properties online. So McKenzieProperties.online. You can see some of our earlier work on that website.
No, that's great. Well, Jules, I just want to say thanks so much for taking the time today and sharing your success with us.
Thanks for interviewing me, Seth. I really appreciate it. It reinvigorates me and reminds me that I'm not the only one out here slugging it out and having a good time with real estate. So thanks again.
That's right. Pleasure was mine. And to you, our viewers, I wish you well in your journey from purchase to profits. See you next time.